You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, that music means it's time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from the OptionsInsider.com, as well as from the ever-expanding, ever-exciting Options Insider Radio Network. A baker's dozen of programs for you guys to choose from on said network, including well over 100 archived episodes of Volatility Views. I don't have the exact, I'll have to pull up the exact number perhaps here while we're chatting on the old program, but certainly quite a few, as well as 400 now of the option block. And you name the show, there's quite an extensive history of programs. Indeed, history of the network going back all the way 8 years this January. So it's been quite a run. This is episode 142 for those of you playing the home game of Volatility Views. And where can you find all those episodes like I just did just now? Well, I surfed on over to theoptionsinsider.com, clicked on the Insider Radio Network tab, and then I chose from amongst the full overlay there, all 13 programs available for you there in the overlays. Click on the Listen Now to hear the most recent episode, or click on the View Archives button to see the archived episodes. And of course, you can always find them iTunes, Stitcher, Aha Mobile, all those fun services, as well as even our mobile app available for iOS, Android, and the Fire OS. And while you're at any of those venues, in particular the website and the mobile app, you can always use those as well to get in touch with us here on the old program. Give us your questions, your comments, your insight, your feedback. We love to hear from you guys. And we got a bit of a truncated panel this week as it is going into the long holiday weekend. We're recording this on Friday, January 16th. Mr. Woodard is moving out hither and yon, I believe, with his family today. But we are joined by our other volatility compatriot, the greasy meatball himself, Mr. Mark Sebastian, from OptionPit.com. And I guess what? Since Jared isn't here, Mark, you get to be the major domo of OptionPit.com. How does that feel?
It's about frickin' time. I'm excited about it.
There's only room for one major domo per show. So if Jared doesn't beat you to it, then or maybe Andrew, then you get it all to yourself.
Andrew's my domo arigato.
He's your Mr. Roboto, you're saying? That's what you're saying?
Yes.
I can see that, actually. All right, with the team all assembled, it's time to dive right on into our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, that funky music means it's time once again for the Volatility Review, the portion of the program where we break down the week that was and still is to a degree from the volatility perspective. As I mentioned, we're recording this on Friday, January 16th. So still a couple hours to go here in the old trading session. And as the day is progressing here, it's a bit of a green day, bit of a rally ho day on the old street. Most of the major indices up fairly robustly on the day. The S&P leading the charge, up about 0.8 of a percentage point, or nearly 17 handles, to well over the 2,000 handle yet again, 2009 to be precise. The Dow, a bit of a laggard, only up about 0.6 of a percentage point, or just a hair shy of 100 handles. And the Q's up about 0.75 of a percentage point, so splitting the difference there. Yet again, over there in the Q's and the VIX cash, after having gotten a bit of a bump earlier this week, now kind of selling off a little bit. It has been a weird week overall from a pure volatility perspective. It started off fairly anemic, you might say, from an overall vol perspective as well as from an overall volume perspective. Starting the week, there wasn't really a heck of a lot going on. VIX was still languishing in the higher teen range, but still in the teens. And then as the week started off, that's when we first broke the 20 handle, and then he kind of vacillated a little bit there in the VIX cash land, getting back down to about 17.65 on the low end of the spectrum before really lighting it up later on that week, where the week started off only doing about 280, nearly not even 300,000 contracts in the VIX, which is a very, very anemic day for that product, and then getting off to doing 800,000 by Wednesday and Thursday. So decent volume towards the latter half of this week. Of course, that correlates with the pronounced movements we started seeing in the broad markets. A pretty aggressive sell-off there in the middle of the week, and now we're starting to see some rally-ho business towards the end of the week. So it's been a bit of an interesting one. Again, been a bit of a, shall we say, schizophrenic week, as we saw a bit of a rally yesterday, after a bit of a sell-off yesterday as well. So it's been kind of schizophrenic to watch what's going on. We sell off, we rally, kind of a crazy one. Mr. Sebastian, what really caught your eye towards, or for the week that was, just from a pure equity perspective? We can get into all the other fun stuff in a bit.
I mean, it's hard to talk about the equities without really talking about what happened everywhere else.
That's true.
And how they were really affected. We saw, in the equity markets, the Swiss market had essentially a black swan moment this week. If you were Swiss, you got absolutely crushed. We had a couple of trading firms go out of business yesterday and today. So there are some interesting things happening, to say the least. But when I look at what happened with VIX, it's been on a slow climb. There's a lot of things in front of it, right? We've got, some real problems in Europe. We've got a potential Greek exit. We've got problems in the U.S. The retail sales number was terrible this week. You've got oil continuing to sell off, which is affecting the U.S. markets. And then, of course, you had the action in Switzerland that I'm shocked that we didn't have a massive sell-off on Thursday after what happened in Switzerland, until you sit down and really think about what the effects and why the Swiss did what they did, which we'll talk about here momentarily.
Yeah, I try to save that stuff sometimes, but you're right. It kind of is hard to talk about anything else without really tying in what happened out there in Switzerland. I believe your Mr. Roboto there, Andrew, called it a black swan of black swans for the Swiss, and that certainly has a bit of resonance to it as well. If you're not familiar, if you've been living under a rock for the past week there, listeners, the Swiss franc, the Swiss essentially let the dice fly high on their currency. They reduced the cap there, and it gapped up, I believe, about 30%.
They completely got rid of their gap. And so think about this. On Wednesday, if you bought a Swiss franc, right? Let's say you bought, you would have gotten, for $1, you've gotten 1.2 Swiss franc, basically. Maybe a little bit worse. And then on Thursday, when you got back, if you wanted to change it out, you'd have gotten out of that 1.2 Swiss franc, you would have gotten like $1.50 back. Just a crazy move in the Swiss franc. It moved against the euro. It went from 1.2 to 1 to now it's trading above parity. I believe it's about 1.1 euro. 1 euro is about 98.98 franc. So just a massive move, a crazy black swan move. But what's really important is really what it means for what I think are the worldwide interest rate markets. And so what I want to talk about real briefly is why they did this. So the reason they did it is because they are unable to keep forcing the peg. So what they were doing was essentially selling the franc and buying the euro to try and keep that 1.2 to 1 peg going. And Jordan, the head of the SNB, basically came out and said, Europe is going to do QE, and we are not going to be able to control this. So, there were smarter ways they could have done it. They could have done some ranges, things like that. But instead, they just gave a ginormous FU to the world, to world currency traders and guys that had that ARB on, and basically put 2 or 3 currency firms out of business and blew up a bunch of hedge funds. So basically, they let the cat out of the bag. Europe's going to do QE. So what does that mean for the U.S. markets? Well, the U.S. markets are going to get a de facto interest rate hike by the Europeans doing QE. So if Europe is doing QE, that is going to cause serious deflationary pressure on the U.S., which makes it basically impossible for the the Federal Reserve to raise rates. I mean, they will cause outright deflation if they raise rates. So essentially, you've got a greater chance now of the Chicago Cubs winning the World Series than you do of the Fed raising rates in 2015 and really probably into 2016, which then, if you look at the equity markets, that brings back the TINA trade. So I think we're heading toward all-time low yields in the 10-year note without any QE, and the TINA trade, which means utilities are going to do great. TINA stands for there is no alternative but equities, and which means utilities are going to do great. You're going to see some strength in, high dividend stocks and also housing. I think I would be unshocked to see the average 30-year mortgage fall below 3.5% by the end of the year, which is going to push housing values higher. So that is really what happened this week, and kind of monumentally how crazy this move really is, and really how ginormous the implications are out of what the Swiss did.
Yeah, the reverberations are certainly being felt across the board. You mentioned all the firms blowing out. My inbox was flooded this morning with press releases from firms saying, hey, we haven't blown out, we're still here. And a lot of them, of course, heavy on the currency side, have gone under, particularly those centered in Europe. This has been, you're right, this is a crazy event. I'd imagine if long-term capital was around today, but they probably would have blown out again. Maybe today this would have been the aberrant event that really threw out their mean reversion model. I think it was Russian bonds at the time, but maybe the Swiss franc would have done it for him this time. And you're right, Yellen seems to have her kind of only weapon in her arsenal seemingly stripped from her now for the rest of the year. So it doesn't leave her with many options here. Pun intended. It has been a crazy week to watch. I was throwing up some. I don't unfortunately have the franc euro graph. That'd be interesting to watch here. I do have the franc US dollar.
It was an absolute black swan. It popped 15%.
Oh yeah, no, I'm talking about the volatility skew to see what the options are lighting up for out
nuts.
there.
It's absolutely nuts. It's parabolic, and it just keeps going higher. It's probably overdone, but just the vol on the Swiss US swap is 31% in February, which, if you consider that normal vol is about 8%, that is nuts.
Yeah, I'm looking here. The at-the-money in the front month here is about 38. It comes off a little bit as you go farther out, as you might imagine here. This is, of course, franc US dollar listeners, and taking about the high 20s, 28 or so for the second month, and kind of dropping off from there. But serious near-term spike here from a vol skew perspective. Still surprisingly flat. Of course, these currency skews, they don't get out of whack that often unless some really crazy things happen. Of course, something crazy did happen this week. But I'm looking at the front month skew is kind of nuts. Once you get beyond the front month here on the franc US dollar, it's surprisingly flat. I thought some more of that concern would maybe carry off a little bit farther into the vol skew and the term structure here, but we're not really seeing that play out, which is kind of interesting. So maybe cooler heads are prevailing in the longer term of the term structure here, Mark. But in the near term, you're right. Certainly Crazy time. I guess to an interesting listening question we're going to have a little bit later as well. Let's dive back into the world of broad equity volatility as we are wont to do on this show. And as Mark alluded to, the Franc really kind of setting the world into a tailspin. I think a lot of us come into this week expected earnings to be the big driver. Earnings were certainly a player, but that kind of aberrant event out there in the Swiss franc really sending a lot of things into a tailspin. We're still kind of seeing the fallout from a brokerage perspective, which firms are going to be around, which ones aren't. It's crazy town out there in that land. And as you might expect, with everything starting to go a little bit topsy-turvy towards the latter part of the week, VIX started picking up some appreciable volume, particularly out there in the VIX options. Like I said, it started off the week fairly weak, less than 300,000 contracts going up. And towards the end of the week, of course, today's session isn't done yet, but towards the end of the week here, we saw substantial numbers, not breaking a million like we saw back in the October and late December 2014 kind of time frame, but still fairly aggressive stuff, close to 800,000 contracts several days, which is fairly robust. Looking at where the heat is, looking at where the interest is, not surprised, of course, the Jan 20s still the hot strike du jour with about 350,000 contracts open on that. That's, of course, come off a bit from last week, come off about 30,000 contracts from last week. Then you drop substantially, the number 2 spot being actually a put. I'm trying to think the last time we saw a VIX put taking the number 2 spot on the hot strike list. Probably goes to show a little bit of how, as the VIX rallies a bit, we see the use case changing a little bit and people actually flocking into the puts for the change to the tune of 250,000 of the Jan 15 puts, which are kind of unched from pretty much this period last week. Then we get down to about 203,000 of the Jan 30 calls, a little bit more optimistic, though, of course, look at the futures, that isn't that crazy. And then the Jan 18 puts, number 4, 181,000. So puts starting to light up the tape here. Number 5, the Jan 21s, 144,000. And then we got pretty much all puts till the end there. Jan 16 puts, 17 puts, and 20 puts was about 140, 115, and 111,000 respectively. And then we wrap it up with a couple of calls, 108,000 each of the Jan 17s and Jan 22s. So some love starting to be felt for the puts when they were pretty much nowhere to be found on the top 10 list for the better part of at least the latter there of 2014. And total open interest out there in VIX options land is looking fairly robust as well. It was getting pretty light there in the November into December time frame. It's now starting to pick up again a little bit over their regular average, which is in somewhere, I believe, in the 5.5 million range, doing about 6 million, actually 6 million exactly open interest out there, about 3.7 on the calls and about 2.3 million open on the puts. Anything surprise you this week in terms of what you saw out there in VIX land, either from a volume perspective or from a movement perspective out there, Mark?
I was not shocked that we held up like this. The reasons we held up were, I was thinking Greece and next week's EU meeting would certainly put a floor on volatility. But, you look at the daily movement, it's hard to not say that an 18 to 20 VIX is somewhat reasonable. If you look at realized volatility, 10-day realized vols around 17, 20 days around 17 and a half. So, that's going to peg the VIX at between 20 and 22. If it's sticking to kind of traditional premiums. So, it makes total sense that this is where the VIX is.
And it's funny, while all this meltdown was occurring in the Swiss franc, I was actually off at a meeting with the SIBO folks, actually chatting about something else that we talk about a lot here on this program. That is, of course, the odd goings-on out there in the short-term vol land, a.k.a. VXST. It's a product we've kind of scratched our heads about a lot here on this program over the past year since it launched last April. I believe it's kind of been a bit of an enigma. It'll do nothing, and then it'll kind of light up on some days that nothing else really happens. And then on days when you think it should be lighting up, like back a couple of weeks ago, and maybe even this week, of course, when you think short-term vol, and indeed the gamma of vol would be attractive to a lot of people, it kind of sits there and does nothing. I had some days this year so far when things were lighting up, the S&P was moving, where it did literally nothing, 0 contracts, which is odd. And especially in the light of the fact that the SPX weeklies, which you'd think would translate well into the VXST use case and user base are growing exponentially. I think they account for over a third or about a third these days of overall SPX volume. That's up substantially from like the mid-20s last year in terms of percentages. So SPX weeklies continue to grow, a lot of love for that, and yet for whatever reason, none of that love has really translated at all into the VXST product. And I kind of put that to the Siebel folks. I said, I can't make heads or tails of what's going on with this, who's using it, why they're using it, why it's not really catching on. And to their credit, they seemed a little bit mystified as well. They say sometimes, you create a product and you think it's a home run, like GVZ. We talked about that on the show before too. And yet, for whatever reason, it doesn't resonate. They did say they added a few liquidity providers to it recently, so they hope that'll kind of deepen the pool of what's available out there, make it a little bit more attractive to people. But I did kind of mention, though, the fact that why does SPX weeklies continue to explode, and yet none of that, not even a minute percentage, seemed to really dovetail over into VXST, and they kind of admitted that that's a bit of a surprise to them too. They thought there would be a lot of translation between the two products, and they said that they kind of realized that maybe now this is kind of revealing that there is a different set of players who are playing in the SPX weeklies versus whoever out there is trading the VXST, which aren't that many people, but clearly it's a different use case. So it came as a surprise to them, kind of surprised me. Did that surprise you as well, Mark, that kind of SPX weeklies are the talk of the town, everyone loves them, can't get enough of them, and yet the VXST just they can't bother with it? Yeah,
I mean, I think there are some smart reasons why that's happening. I think you and last week covered a bunch of those, but there's the liquidity is a problem, and then finding the right person to actually be the user is the other problem. That's really the issue. They don't have the right user figured out yet.
Yeah, clearly. I mean, and they admit that, which is interesting to their credit. Looking here at the numbers, SPX weeklies were about 32% of overall SPX volume in 2014, which is another record high, up from about 23%.
And I was talking with some guys that actually do try to use it, and if they go to lift a 5 lot of the VXST futures, the entire curve disappears. So there's a lack of liquidity in the product as well.
Yeah, clearly that's an issue. So they have addressed that, so maybe that will kind of fix some things. And I was chatting with their CEO, Ed Tilley, who used to be a market maker, so he has a decent insight into these things too.
He was one of the best option traders there are.
And he kind of admitted that they kind of launched the product at a bit of an inopportune time, realized vol when they launched it was probably in the 5 or 6% range. So the use case for a product like VXST really wasn't readily apparent to a lot of people. So it kind of took a lot of time for them to maybe kind of wrap their heads around and actually to see an environment where it might be more useful, like maybe now. Maybe if this continues going forward, if VIX Cash can continue well north of the 20 handle, realize vol can at least stay in the low teens, then maybe a product like VXST might see a little bit more of a use case. I thought that was kind of interesting. I don't get a chance to really dig into what's cooking out there in VXST land. I got a chance to do that this week. Look for that on the site and in our newsletter later this week as well. We touched on what's going on out there, and of course the Swiss franc. That is the big story from a commodity perspective and from a overall futures and futures options vol perspective. It's a big story when it trumps crude, which has been the number one kind of commodity story for the past few months. Crude, of course, continue its decline this week. We thought we saw a bit of a rally again. Brent had kind of risen above $50 a barrel. I'm sorry, the WTI rose above $50 a barrel. Seemed like that was going to maybe break the trend a little bit, but nope, it's selling off again. So crude continuing the downward movement out there. We are seeing out there, like we talked about in some recent shows, more interest to the upside. That's not really a surprise given the fact that this thing has just been cut in half literally just in the past few months. People might start to see this as an opportunity to maybe spec on the upside. So far, those bets haven't paid off, but we are seeing that start to filter into the volatility skew out there. It was very, very flat, if not downward sloping to the upside for a long time. Now we're starting to see that tail pick up. People are starting to say, hey, I might take a flyer on some of these, looking here at the inflection points, maybe 70 handle calls and above, which doesn't doesn't seem that crazy given it wasn't trading. It was trading there not too long ago. So interesting stuff. Still afoot. Puts, of course, still have a bit of a juice, less than they did before, but still pricey to make some downside bets out there, and still interesting maybe to line up some reversals and some verticals out here in these products because there still are some decent opportunities. Not as good as it was before, but still interesting stuff. Mark, I'm sure out there in the pitch chat, you guys are still, when you're not talking Swiss franc, are still talking a lot about crude as well as the good old USO.
Yeah, I mean, that's been the other piece that's been busy. That's really the, that's the last piece. I think the bottom's in crude. We're starting to see vol fall off and stabilize. It stopped having this kind of parabolic sell-off. Like I said, I just think the bottom's in. And I would not be a seller of crude anymore. And, I would maybe be a seller of crude volatility.
Start blasting out some puts out there in USO.
Yeah, I mean, that's what I was looking at today was in WTI blasting some puts. There's a lot of premium. Let's just, for example, let's just do USO because it's equity. It's super easy. And if I go 1 month out, I can get $1 for, I can get $1 for a put that is, call it 2 or 3% out of the money. That is just massive volatility for the name. And, I gotta give me a second. I can pull up WTI as well. But, WTI vol is, just as high. OVX is the USO vol index. OIV is the crude vol index. And that's one that if they had handled it right, could have been the one that would have been the one that I would have picked to be the most interesting trade because of because WTI is so different than equity, even more so than gold. So the March future is 49.16 right now, and I can sell. I mean, the at the money put is $3, and let's see. I could sell. This is interesting. I could sell the 45 put and get $1.50. I mean, that's some decent premium.
That's some juice.
They're actually begging you to do like the 1x2. Like think about like the 48.5, 45 1x2 for a credit.
They're begging you.
Take delivery net at like $41, done and done.
Famous last words. I think people were saying that too back when it was like 85, saying they're begging me to do the 70-65 1x2.
They were.
They were. Yeah, you're right. There's just a lot of juice lurking in them. There are crude hills in the Texas team. We've seen a lot of that positioning as a result. Still some premium out there, but of course people have been blasting away. It's not near the crazy record levels it was not too long ago. Just looking at some of the numbers here coming out of the Swiss franc stuff and the different firms that have shut down. Deutsche Bank saying they lost about 150 million after the move. They don't have the name of some of the other brokers, a UK retail broker, New Zealand retail brokers. A lot of these FX heavy brokers and FX in in Europe and Asia are really just, they're still struggling to assess the damage, they say. So I think we'll probably see more brokerage firms shut down over the weekend. Big ones here in the States like RJO have already come out and said we have no debits as a result of this. So if you have accounts here in the States, you're probably going to be all right. I haven't seen any large firms out of the U.S. that seem to have been enormously impacted, but of course that depends on where you're putting up your stuff. And when the FX world, those firms get a little spotty and a little scattered throughout the...
Or get sold to Jefferies.
What was that, Mark? We didn't hear that.
FXCM.
Oh, okay.
They're going to go out of business, or if they don't get bought. So the stock was halted this morning because it was down so much. So they're a group that's going to go out of business. There's another couple that are looking to potentially go out of business.
Yeah, it looks like they're looking for a $200 million cash infusion from Jefferies.
Yeah, good luck with that.
Afloat.
If I'm Jefferies, I just let them go out of business and then steal all their clients.
That is kind of the way it has worked in the past. We have seen that before with Knight and a few others. Oh, we can't help you. Go to zero. Okay, now we'll buy you for pennies on the dollar.
Yeah, exactly.
It's happened before. Maybe we'll see that again. So yeah, there has been some interesting. In this article, they even mentioned Knight in that same article. So yeah, interesting stuff afoot out here. We probably haven't seen the end of the fallout in the Swiss franc, and of course, as these firms collapse. What ramifications that'll have for volatility will be interesting. Unfortunately, we don't have Jared on the show today. He's usually our guy we turn to look abroad for international volatility. But that means we just have more time for you guys to make your voices heard on the old program as we roll right on into our volatility voicemail segment.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL, posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody, welcome to the Volatility Viewpoint. This is indeed the portion of the program where you guys get to take the reins and let your questions or comments be known. No shortage of ways for you guys to do just that. Surf on over to the mothership, theoptionsinsider.com. Leave your comments, your questions. Use the website feedback form. You can get to us about 8 different ways over there on the old website, or, of course, find us on email, questions@theoptionsinsider.com. Just be sure to put question for the Options Insider or question for Volatility Views, your show there, so we know where to route it, or twitter.com/options, facebook.com/theoptionsinsider. We're even on Stock Twits at Options Insider, I believe, or it's all baked into the mobile app with the exception of Stock Twits. So you can find all of that. No shortage of ways to make your questions known, just like our first victim does here, Mark Brant. I think Mark gets the award, actually, for not only having 3 Marks on the show now, but probably gets the award for the biggest volume of questions. We get a couple of Twitter questions a day, it seems like, from Mark. He sends in some good ones.
He was blowing me up on Twitter the last couple of days.
Oh, was he really? He's very active out there on Twitter, which is good. We love to see that. We love to see you guys chiming in. The more questions, the merrier. I picked out one here from Mark. Actually, interesting one. He writes, how long does VIX backwardation normally last, and are the reversions to contango sharp or mild? An interesting question. You know, of course, on first blush, when you think of backwardation, you think of an event like this week. It's kind of almost by definition near-term stuff because it's the near portion of the curve that is spiking in relation to everything else. So that's usually something that's crazy, that's constricted to the near term, and that's why you get that very, very sharp spike. But it can last and sometime a little bit longer than you might expect, as we've seen in the past as well. I think the interesting part is really the second part of the question: are the reversions to contango sharp or mild? That's another interesting part. I think, you know, it kind of depends on the event. Wouldn't you say, Mark? Sometimes it gaps back.
I think it's the speed with which it pops and the duration of which it's high. The longer it's in backwardation, the slower that reversion is. And, you know, this is actually something I was talking about on Twitter in detail today, over this week, Mark. You know, one of the, and it's something we talked about last week with Ewan. You know, you know, one of the tweets that I got was basically, boy, I'm glad I played VIX future cash convergence, because I noticed that the VIX cash was trading above VIX future, so the future had to go up. And I wanted to be, and I basically said, that's not really how it works. You actually, most of the time, they are in contango. And so, you know, it really depends on the event. When we get these little one-off events that cause vol to pop, it's typically going to come right back, you know, in a couple of days. But something like this, where we've now had an extended VIX for going on 2 weeks, it's going to take us a week and a half to get back down to a 14 VIX if things really do calm down. Because the longer things are crazy, the longer the market holds things high.
I think that's probably the best barometer I can think of as well, is just how long you are in that backwardation, because that's pretty much, it seems like the only driver I've seen for how long it takes to come off the other side. We have all these little flippant, aberrant events all the time that pop us up a little bit in the near term, you know, but you're right, they come off in a couple of sessions because they're kind of just near-term noise, near-term fluctuations. But something like this that may be more systematic, it probably will take a little bit longer for this kind of thing to work out of the system. So I think that's probably the best barometer we can give you there, Mark, is however long we're in backwardation, you expect a much longer drift to the downside. But you don't see the sharp reversions unless it is kind of one of those really near-term aberrant spikes where it spikes up and then it might spike back down just as aggressively. So that's probably where you get the more.
Yeah, when you get a really aggressive one-off move, that's when you'll see things pop. Or like, you know, there's one occasion where we did have like a vol short squeeze. That ended up being a short move. But most of the time, really kind of look at the duration of how long VIX was higher then multiply that by like 0.6. And that is out of my butt. But, it's going to take about, for every 2 days vol's really high, it's going to take a day or two to, somewhere in that range for it to come back down.
Yeah, that's probably a good ratio. I'm trying to think of any times, like you mentioned that one time where we had a long extended period of backwardation and then it just kind of exploded back down. I can't remember any time like that in recent history.
2011 is the last time.
Yeah, pretty much. Yeah, it's been a while. So since then.
It's been a while.
So yeah, most of the time, Mark, you're gonna have if it's a structural issue, it's gonna take a while to work out. Whereas the little whipsaws, be careful playing those. All right, another question. We got time for a couple more here from one here from Analogous, maybe just trying to be silly, analogous, whatever. However they want to pronounce that. They write, I've heard you discuss previously buying options prior to earnings to capitalize on free gamma with no decay. I believe that's Andrew's favorite trading strategy there, Mark, the free gamma prior to earnings trade.
Oh, yeah.
They go on to write, my question is about after earnings when the premium collapses. Is that technically options decay all coming out of the option at once, or is it a collapse of implied volatility that is erasing the premium in the options? If the latter, then is the decay technically occurring every day prior to earnings and just being overcome by increasing implied volatility leading up to the earnings event? Good question, Analogous. We see this a lot. I think this is partly our fault for causing this confusion. We throw around this notion of, hey, you get free decay going into these earning events with strategies like this. And it is kind of technically true, even though the actual fundamental the decay is coming out. It's just being offset by something else. There is no free lunch. So what you say at the end there is correct. If you look at, I'll have to maybe I can pull up some numbers a little later. I can show you some specifics. But if you look at a lot of these earnings events, pick your big poison of choice. I don't care, Facebook, Google, whatever, and look at the implied volatility numbers in that chart going into the earnings event. You'll see they're slowly creeping up going into that event. So even if there is decay coming out of those options, and there technically is, it's being offset, if not very much dramatically offset, by that increasing implied volatility. And as you mentioned, the collapse here, you're right. Look at the implied vol numbers before the earnings event and look at the implied vol numbers the day after, the session after that event is announced. I think you kind of answer this question yourself. You'll see those implied volatility numbers. Usually, if there's an aberrant event, that won't happen. But usually that implied vol just comes crashing in. I've used the analogy before of a balloon, a kind of a volatility balloon filling up, then it just pops right after the earnings event. So effectively, you're getting kind of all that pent-up decay coming out, if not a lot more, after the event. So the effect is kind of similar, even if the mechanics at work are a little bit different. Mr. Mark, I know this is one of your favorite strategies over there at the pit. What do you have to say to our friend here, Mr. or Mrs. Analogous?
I think you hit the nail on the head. I really don't have a lot to add. Yeah, I mean, I would say it's more a drop in implied volatility. I like to say that, one of the things that is interesting is it's not so much, a lot of people think that there's like a huge earnings bid up into an earnings announcement, and that's really not the case. What happens is vol goes up because the straddle decays slower than the model expects. And that's how volatility increases. So, it's volatility coming out. It's not just all decay coming out at once. It's a good analogy for explaining it, the decay piece, but really it's just volatility collapsing.
And maybe we should stop calling it decay so we can stop
No,
confusing
absolutely
people.
not, because that's the easiest way to explain it.
I'm looking here. I'll pull up some numbers later so you guys can see it in action. Just pull up your favorite name, Apple, Google, I don't care which one it is, and look at the charts going into earnings of what's going on with implied, what's going on with decay, and maybe run some models on your brokerage firm. They all have those abilities to pull up your different Greeks. You could see this at work in the marketplace for yourself. But effectively, the effect is the same, and that's why we like that kind of that free gamma strategy going in because you have that nice offsetting movement to make it. Sometimes you pay a little bit, sometimes it's free. It depends on the underlying and what you're trading. But all good stuff. All right, that's about all the time we have for you guys on the show today. Maybe we'll have a whole listener question show someday. I really like those. But meanwhile, we're going to move right on into our crystal ball segment.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, listeners, you know the drill. This is the portion of the show where we tell you what we're watching, what we're keeping an eye on for the week to come. I think if you had asked any of us on the last show we did with Ewan if we had expected the Swiss franc to essentially remove the cap, all of us would have said you were crazy. So black swans are indeed the outliers that we don't anticipate on this segment. But that being said, we do have some interesting structural things at work in the market right now from a pure vol as well as from a currency and commodity vol perspective. So there is a lot to parse. Mr. Sebastian, you get pride of place because you're the only man out there today. So what's your take on what you're watching for the week to come?
I think that we've got that ECB next week. VIX expiration on Thursday could be really interesting because, we've got the ECB meeting on Thursday. So, I'll just say I'm not going to be going short that straddle into VIX expiration on Tuesday night.
Probably well said. That's a good point, too. It is getting that time of the month when things get a little crazy in VIX land around expiration time. So with all the other stuff at work, VIX is probably already going to be pretty crazy. And then now you add in that little wrinkle to the mix, and it should be a very interesting times. If you're one of these people out there who always complains about the settlement and all this other stuff like that, then just avoid it. Close out your positions going into those days, and you can kind of be all right. Maybe this week is probably a good example of when you might want to think about doing that, because it's going to be all sorts of craziness going into the middle part of this week as all those factors start to play themselves out in the marketplace. In addition to whatever else we have coming out of Europe next week, should be all sorts of crazy. And unfortunately, that's all the time we have for this kind of truncated episode of Volatility Views. But before we go, as always, I want to check in with my cohorts here on the old Vol Views panel, see what they have cooking that may interest you. Until the next time we can all gather together around the old Volatility Views table. And Mark, again, you're the only guy out there, so you get all the plugs today. What's coming on the pike in the land of the pit?
I think I've got some webinars coming up next week, but we'll have our webinar of the week next Wednesday. We're going to do our webinar of the week Wednesday the 28th. It's going to be using volatility to trade for direction. So look out for that one.
Sounds good. Check it out over there at optionpit.com. And Jared couldn't join us, but of course, surf on over to BGC Partners if you want to learn more about all the fun stuff they have going on over there. And in the meantime, if you haven't done so already, surf on over to russell.com and check out all the cool products they have cooking. I was talking to those guys this week at the big Securities Traders Association of Chicago event, and it sounds like now that the dust is settling from the big merger over there with Russell, they may have some cool volatility products coming down the pike. I don't want to let the cat out of the bag at all because it's all still being planned out, but they may have some cool stuff in addition to what they already have cooking with RVX over there, so it should be pretty interesting stuff. Stay tuned for that. And on behalf of Mark and, of course, myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this program and for making it such a success into 2015. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. Or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.